welcome everyone and welcome to our webinar today, which is on SIP or systematic investment plan versus lump sum investment and what to do in the current market situation. So my name is Barbara and I'm a business manager with Crystal AI. But today's panelists are Edward Pai, who is a relationship manager of Crystal, is Swapnil Mishra, who is our head of private wealth, and we have Thomas, who is our head of advisory. So these gentlemen have a lot of experience in the financial industry, working in various financial institutes. So this is the best time if you have any questions, be it on SIP or anything else that you always wanted to know, please ask your questions. You can use the Q&A tool, which you will find as an icon either on the top or the bottom of your screen. And if after this webinar there are any questions left, please just send them to support@crystal.ai and we will be happy to answer them. Just one more information. So this webinar is being recorded and we will share the recording afterwards with you so you can share it again with your friends. And now without further ado, I want to hand it over to Swapnil. And Swapnil, could you start us on what is SIP and does it make sense to use it in this current market environment?
Sure. Thank you so much, Barbara. In terms of the topic, I must admit that webinars, well, everyone is doing webinars because everyone is stuck at home. So there's no other way to communicate and talk and share, but to use webinar as a challenge, as a channel for communication. In terms of topic, we debated and we thought systematic investment or dollar cost averaging. I mean, this topic has been spoken and discussed, and enough has been written about this topic. So, we thought that maybe it's not something which we would want to dwell a lot in terms of explaining what a systematic investment plan or staggered investing or dollar cost averaging is all about. We all know the basic concept around this. And we thought really to use case studies or use actual usage of this strategy in different kind of market conditions and use that as a backdrop to understand the nuances or what are the challenges and what are the misconceptions sometimes and what works and what doesn't work. So decided to keep it authentic, and hence we decided that let's have Edward also here, because Edward is our relationship manager, but he's also an avid supporter of systematic investment plan. And I remember when I met him last year for the first time, and I had not even joined Crystal at that time. One of the first things he had asked me, what about SIP? Are you considering doing an SIP? So yeah, here we are. Edward, can I pose this question to you as to what are your thoughts on systematic investing, especially based on your personal experience?
Okay, thank you, Swapnil. Yeah, so to me, I am definitely a true believer of systematic investing. And in actual fact, I have been actually doing my monthly SIP religiously up till today, ever since I got my first paycheck in 2013. So it has been a good, I can say about 7 years of monthly SIP. I think for me, the SIP is good because, with so much commitment in our life, as well as so much information and noise in the financial market. For me, it's really tough for anyone to make a consistently reliable forecast and a decision about risk allocation or where the markets are going. It's really tough, especially at this point of time right now. And to me, one of the key benefits that's really appealing and as well as apparent to me is that SIP, truly mitigates the investment error most of us make especially due to psychological biases. So we, as human beings, seems to be rational creatures, rational. But when it comes to investing, we display all kind of predictable irrationality, like timing the market, being too risk averse, missing the opportunities, and being overly optimistic, resulting in taking huge lots instead. So these, in fact, are all a bit too stressful for me. Yeah, and with SIP, it actually reduces all this stress because firstly, you are constantly participating in the market, so you're not timing market. And with that stress taken away, what happens there? You have much more resources, especially mentally, to determine your asset allocation strategy, which is also I am a true believer in it as well. And of course, secondly, with SIP, you have the scalability to invest with a consistent approach for a certain time horizon. Let's say you give yourself 5, 10, 20 years time horizon, depending on your investment objectives across global portfolios of securities. And lastly, it is a very scientific approach, I must say, which I like about it, because there has been many experiments and academic studies as well that support the empirical evidence, which shows that systematic investing actually allows you to survive longer in this market and generate higher returns as well, and a superior performance compared to people who actually time the market. So I guess these are the benefits that I truly believe in, and this actually appeals to me. So I think, for now, we can actually also look at other examples of SIP, because SIP itself is good in a way that it's not limited to investing small amounts of money over the decades, but it is also an effective tool for sophisticated investors as well, who actually are faced with high market volatility. So we have our head of advisory, Thomas, who is also a big believer of investing in tranches, also called SIP as well. Yeah, Thomas, please.
Yeah, so no, I think you summarized it up quite well. Look, I think there's two very difficult problems to be solved when it comes to successful investment, which is on the one side the asset allocation, and the second one is the timing. Now, about asset allocation, we spoke about it in our last webinar a little bit, and I think we do have a broad suite of tools to our availability that helps us with that. Now, we wanted to talk a little bit more about the timing. How can we address the optimal timing? And let me tell you one thing. For me, I've been doing this for over 25 years now. I've been myself also very terrible with timing. I find it's one of the most difficult things, and also the professionals, they have a tendency to get it wrong because there is often that extra factor that you have not considered or that is coming in, and that's kind of like throwing the plan to a toss. And this is with an SIP or a systemic investment plan, what it helps you to do and to achieve is you are minimizing that emotional factor that often leads to bad investment decisions. It's sometimes the view of like, okay, situation that we have right now, the market has dropped substantially. We have rallied from the lows a good 35 to 40% from the lows again. So there are people who are just tempted to say, oh, I missed the low, I go and chase it. Yeah. With an SIP, you're removing a little bit this emotional attachment to your investment decision. And you're just being meticulous and systematic about your approach. You're buying at these points in time. Yeah. Now, does it mean that an SIP always needs to be static, and well, how much time should we space it out? I think that's the next difficult question. It's never going to be easy. And I think there is a certain technical element that has to come here as to answer the question to yourself, by when do I want to be invested? Is it a lump sum that you want to invest, and by what time, by when do I want to be invested? And that gives you an answer as to how do you want to drive your allocations. Second thing is, if it's an SIP of a recurring extra saving, then I think it's a fairly easy answer to that question, because you will know from your income you have a disposable few $100 or $1,000 a month that you can invest in an SIP plan. And that's kind of like what's the best way to structure this in terms of timing and to go about that. Yeah.
So thanks so much, Thomas. I think that's a very interesting point you've just raised. So we have one scenario where we are talking about investment of savings every month over a period of time, right? And that's where, I mean, historically, systematic investment planning has been associated with this monthly tranches. And of course, we've seen the mutual fund industry kind of drive that concept home in many countries. And there is a natural discipline to the entire structure, because every month you receive a salary, and every month there is a certain amount which goes into paying, let's say, an EMI. It also goes into saving some money. It goes into CPF, and it also goes into some investments where there is an appetite to take higher risk, because the systematic investment plan by design is with a long-term perspective, and you're not trying to double your money in 3 months. You're trying to build value over a period of time. How would we extend this specifically to a scenario like this, and in the current environment where market volatility is a given in light of the kind of macro events that are happening? I mean, the fact that millions of people are staying at home and not eating at restaurants, they're not using taxis, they're not flying, they're not going to hotels. So clearly there's a lot of things happening. There's a lot of uncertainty. I guess my question to you, Thomas, would be, is there any way that this strategy is relevant, even if we were investing, let's say, a lump sum amount of money, or have allocated that, or have the luxury of sitting on that cash, let's say $10,000? Is that strategy is it relevant in that situation?
It is absolutely, because I think one important function that an SIP also has is it is a vehicle to minimize volatility by getting wrong timing, being exposed to that. And I think in a situation like now, when you have such a wide distribution of possible outcomes in the next couple of weeks even, it is a good way to mitigate that risk of getting in at the wrong time, I would say. You know, you are also minimizing the, I would say you are able to average. It's a little bit like dollar cost averaging, but in a smaller case, in a smaller period of time. So if we think that between now and June, say, for example, or now in July, that's going to be the time when market may turn around because of situation normalizing coronavirus, but you don't know, because there might be a second wave like what we have right now in Singapore, where the country again goes into lockdown. We look like we reached the other side already, now it's back again. We might see something similar in the US as well, especially since they are not as stringent about their measures as Singapore is, for example. So there are a lot of uncertainties. There are a lot of possible outcomes that we still have. And therefore, I think that's one way to create a small sort of like long volatility aspect in your portfolio by maintaining cash. Like we said this before, that cash is in crisis times or in times of extreme changes, one of the most valuable assets that you can have, because it's a very powerful tool that you can then deploy when the market comes to a level where you say, okay, now is the time. And you may also as well shift gears. Yeah, when we have extraordinary changes to the market, where, for example, like what the Fed did, that they came in with quantitative easing and QE unlimited for corporate bonds, and last week also for high yield bonds, that has sort of like accelerated the timeline of recovery that we were looking for in the bond space, in the fixed income space. Yeah, so I think we need to maintain also that flexibility as investors to take that switch between offense and defense. Yeah. And say, look, there is a very specific opportunity on fixed income right now, given that there is a floor in the market due to Fed buying. So that is an opportunity that will likely go away in 2 months. So there's no point of doing an SIP over 6 months. Yeah. And one way to do this is as well, I mean, we offer on our platform, Crystal, we also offer not only SIP, but also SWPs, so systematic withdrawal plans, where you can work exactly the opposite way. If you have gone into an investment and you are invested in a lump sum and say, okay, over time, I would like to reduce my fixed income allocation, for example, and shift it into equities. So you are able to automate it by putting up a withdrawal plan, selling your fixed income over a couple of months, and shifting the proceeds into equity, for example. Wonderful tool to time out or to minimize the risk of a strategic shift in asset allocation in a portfolio over a period of time.
Yeah, no, thank you. I think one of the words that even Thomas mentioned, Edward mentioned earlier, which was around the keeping the emotion out. And I think I can personally relate to that. And in terms of the SIP itself. So in fact, Thomas, you may recall last year, 2019, I had agreed that there will be an SIP. And I think it was in May that after 2 tranches of that SIP, market had already rallied. And I took that decision based out of infinite wisdom that markets have rallied too much. And I think I'm going to hold back the SIP investment. And then I resumed only much later part of the year in terms of after taking a break for 6 months and missing a large part of the rally. So that brings me to the question is expert views and emotions tend to influence our decision making. Emotions, because we are human beings. So emotion is a very integral part of our makeup. I mean, we live with feelings and emotions. So we can't eliminate them because then we would become a machine. And we have the algorithm for that, but as human beings, we can't. Edward, in your view, how has that helped in terms of keeping the emotion out and keeping the discipline in with the investment making process?
Okay, so the thing for me is that personally, in terms to keep out the whole emotion part, one thing is firstly, like what you have mentioned, discipline is very important. And one way to actually keep that discipline is look into your investment horizon. That's one important factor as well, because you definitely have investment objective that you actually put yourself for the next maybe 3 years, 4 years, or 5 years. And I guess the whole thing is to actually keep the flow of your SIP going in accordance to your investment horizon and your objective. In that way, you will have a clear focus and also a bigger picture of where the whole your investment is actually going. So I think that's one way you can actually keep in track of your SIP and your investments as well. Yeah.
Okay. If we take a look at some of what could be a potential is there any specific asset class or strategy which is suitable for an SIP, Thomas?
Yeah, I would say, I mean, we said that we use SIP to minimize volatility across your investment decisions. So therefore, an SIP on a more volatile asset class is sort of like a better way to deploy this. But there is no straightforward answer. I mean, you can use an SIP for everything. I personally, for example, I used an SIP to buy gold because that's the same story. I know that I knew that I wanted to increase my gold allocation in the portfolio, and we have been talking about it since early 2019 about that. But I didn't know when is the right timing, and I'm very happy about that because I did buy gold when we had the last spike at the end of last year, and I thought, oh my God, I just got the high, and then I bought again when we had the last dip. So, and I was feeling very good about it. That yeah, actually I got the low on this recent move, but in hindsight, you just don't care about it because you're just looking at the average number on that. So even for something like that, you can use an SIP. But generally, the general wisdom is that, and it's also like SIP, and that is also one of the questions that we have in the Q&A that I see in the here is difference between a SIP and dollar cost averaging. That is, in essence, it's actually they're similar. Yeah, they're the same thing. They only have different labels to it. Yeah, but dollar cost averaging is the same thing, that you are taking the approach of averaging out your entry level of a position, of a stock, of a index, of an ETF by buying over a fixed period of times. But make no mistake, an SIP, the dollar cost averaging, also sometimes is mistaken by doubling down. Yeah. So an SIP, the purpose is not to double down when your position is underwater. It is really about having a plan of regular investments, of structured investment. It's not when in trouble double. yeah, that you double up on positions. That is not the purpose of an SIP or dollar cost averaging.
I guess doubling down you do when you're at a blackjack table and you can't go all in.
Exactly.
And equity markets are the closest you can get to a casino in today's environment, because all the casinos are also shut, I believe. I mean, as an offshoot, one of the questions we have received is on view on gold. Since you kind of provoked that point by mentioning gold. Gold is something which is continue to be bullish in terms of as an asset, or we're taking a view that it's systematic investment. So don't think too much about the view on gold, but rather an important part of the portfolio in terms of allocation.
So I do think that gold will play a more important role in investors' portfolios in the coming years, and it's more of a macro view, yeah, about what's happening in the entire market. That we are currently faced with two novel situations. One is that interest rates globally are at the zero boundary. So we have had in Europe for the longest time negative rates, in Japan as well. US is now going down the same path. So you will have all global or important economies going near the zero boundary by in a foreseeable point of time. And there, at the same time, you also have unprecedented monetary stimulus that is not really a debasement of money, but it's getting into the same direction. So I do see gold as a store of value amongst other things. It is not something where I would say it's a trade. Yeah, it's more of a tactical asset allocation based on a macro environment. For me, gold is always an insurance policy, and I think that insurance policy is very precious. Yeah, the same way how you will increase you're tempted to reduce your fixed income holdings when rates go to zero or to negative rates. People who have not been forced to hold fixed income instruments like pension funds, etc., for the asset allocation purposes, they have been reducing that in Europe, for example. So yeah, in a nutshell, long term, I think gold is at the moment a very special situation. How far it's going to go, hard to say. And again, as I said, that's why SIP is for me in gold a very useful thing, because comes again to this emotional and thing. There's so many distractions as well. If I compare gold now to other asset classes, like I've been looking at the gold-silver ratio, for example, also at record levels, yeah, has hardly ever been that high. Or you look at oil in gold terms, with oil price being where it is, that has also been throughout history a relatively stable relationship, has blown out. Puts me at certain decisions at that point in time where you start to doubt, is it good or not? But I'm still convinced in the long run that this is a good asset to have and important for any portfolio build.
In terms of disadvantages, one of the questions that we have received is, what is the disadvantage of using a systematic investment plan? A clear disadvantage is if there is a very sharp V-shaped recovery. In that kind of an environment, if maximum amount of risk is added onto a portfolio, it stands to gain. Now the thing is, we don't know when the V-shape happens or when the sharp recovery happens. We don't really know. There are various scenarios that can be plotted, probabilities that can be assigned, but unfortunately, all the scientific analysis can be done on backward-looking data, and in terms of forward-looking data, it's quite difficult, and that is why systematic helps keep some of these aspects, out of the decision-making spectrum. Yep. In fact, while preparing for this webinar, we thought, should we share some charts on explaining how SIP works over a 15-year-old period of time, 15-year time. And then I was talking to Edward and I said, we don't need a chart. We can just have a picture of his 1.5-year-old baby and say, this is SIP is here because I have the time horizon, because I have a child who's young. So I need to save and plan. So for long-term investing, which is 10 to 15-year horizon, its systematic investment plan tends to be an easy decision. But I must say one thing, in systematic investing or any investment for that matter, the cost of the access to market becomes very relevant. And this is a feature which is not commonly discussed in terms of any conversation around systematic investments. But if there is something which is being invested for a long period of time, then how much money is spent in executing that investment and managing that investment is a very crucial component. So if there's a 10-year investment and one is spending 2% every year or 3% every year just because the fund manager has fees, then we need to really rethink that. And that's, again, one of the things which has increased the market for ETFs as vehicles for systematic investment plans, because they are low cost and they allow the application of a systematic investment plan over a longer period of time, where the fund manager fees and the costs of execution is a relevant point.
Yeah, it's probably, we have actually one great question from one of our participants, which I wanted to pass on to you as well, since you said about long term. So what's the end goal with an SIP? When do you know enough is enough? And when do you realize your gains and stop the SIP or sell and go into a different asset?
So, I mean, I remember about 6 years back, I met a student in SMU. And this is when I go there every year, kind of adjunct for one of the courses there in the School of Economics. And he was saving, if I recall, it was $150 a month. And the whole idea was that he wanted to save because at the end of 5 years, he wanted to get a ring because he wanted to propose to his girlfriend. So in his case, that was the out. The whole SIP that he had running for himself was for a goal which was to propose to somebody that he knew, and he wanted to liquidate all the holdings. So I would say SIP can be linked to a goal. Personally, for myself, I like using only because it helps deal with the emotional issues. Especially when you're working in the financial industry or when you're just reading. I mean, you read Economist and you will have a view on the market. You read the Financial Times, you'll have a view on the market. So it is really tough in today's environment. I mean, we've reached a point where we've become almost doctors because we are able to read some website and have some opinion on a medicine or on how to treat patients. So if you want to keep the emotion out, I think it's important, which means time horizon is relevant to whether you link it to a goal or you may keep it independent of a goal.
So I also have a question on this because Thomas mentioned that, like in one of the last questions, that 6 months, for example, is too short of a time frame to start an SIP. And obviously 10, 15 or 20 years is a very long time frame. So I'm wondering, what's the minimum time frame I should think about when starting an investment, when starting an SIP?
That's a tough one. Let's give it 5 seconds to see if anybody picks that up.
I take that up to me to have a crack on that. So if it's a one-time SIP or if it's an SIP for lump sum, then 6 months I think is sort of like appropriate. I mean that 6 months is too long when it is, or is too short when it is a specific situation that is emerging. But I would say ideal time to get started is dependent on two things as well. And this is also going to help me. One other question from one of our participants in the queue: the difference between SIP and dollar cost averaging. Correctly pointed out that there is a limitation that we have when we do an SIP, in a sense that we can't do fractional units on ETF that we are offering on the platform. So I would say, even if you set up an SIP and you set up the SIP for say 5 years or 10 years, it is important that you are reviewing that SIP in regular intervals, say whether it's on a quarterly basis or whether it's on a semi-annual basis, because a few things might change. One thing that might change is that the price of the ETF might change in a way that you are not able to get enough units because we can't give you fractional units. Take, for example, the S&P 500 ETF SPY, trading at 280-ish at the moment. That one, if you are trying to do an SIP for $600, you're getting 2 units, yeah? And then if SPY goes up, you would still be getting, you might be getting lesser units. You only get 1 unit, and the remainder is accumulating in cash. Yeah, so you would be skipping 1 month basically. Then the next month, when there's sufficient cash again, then it's going to get executed again. So this is something. It's a technical thing that requires you to review it. But I would also encourage you to review it on a regular basis, because there might be changes and opportunities in specific sectors that might be relevant for your SIP or geographical allocations in the portfolio that would require you to change what you're investing in.
Okay. We have one question here which says, is the stock market crash over, and are we looking at a bullish scenario, V-shaped recovery, uptrend in the stock market? Is it a false dawn as seen before the 08-09 financial crisis? I mean, I would love to be honest with this answer. I was there in 2008 managing a portfolio of clients and managing a team. In those days, I used to work in a private bank, and the one thing that 2008 and even the SARS crisis taught us was we don't really know. The honest answer is we don't know. And when we don't know, then becomes the strategy of how do we deal with this lack of knowledge of what the future has for us. And there are various kind of strategies. So a diversified asset allocation strategy or a systematic investment strategy for the risk onboarding in an investment portfolio. These are strategies to mitigate the lack of having just a crystal ball, which can tell us what's going to happen in the future. So I would, in terms of managing a portfolio, I would rather spend time in aligning it with the expectations of the portfolio or the investor, and using strategies that are available to ensure that they help in coming as close as possible to the returns for the portfolio, rather than trying to center the investment decisions around predicting the market, because predicting the market is going to be extremely difficult. I mean, if you just take the last 2 weeks as an example, the speed of recovery and the amount of recovery has both surprised a large part of the investor community. So I would say, instead of trying to form a view, because the honest answer is we don't know where this is going to be. We have one more question on REITs. I mean, in terms of full disclosure on REITs, I have an SIP which is going on, because I feel, I mean, REITs is a segment which I would want as an allocation in my portfolio. So I'm doing an SIP on REITs. Edward, what is your experience been with REITs? Is that part of your portfolio as well, or?
Yeah, I think for me, as an asset class, I mean, REITs should be part of a heavy balanced investment portfolio, right? Because REITs actually give good dividends as well, as a passive income as well. And then, and REITs also, it continues to be a long-term investment. So I guess it goes in hand with the investment horizon that you have. So it should be part of your this portfolio, I believe so, and I strongly believe in that as well. And I think REITs probably have actually come down quite a bit with the recent market, and probably is also it's good that if you can actually do SIP on REITs as well as part of your overall asset allocation. Yeah.
I think in both ways, for REITs and also the general market, there's still potential for further downside. I think once reality sinks in into this market, and similar to comparison that you made, Swapnil, with 2008, 2009, where we have seen this sharp bounce back until October, after the Lehman bankruptcy, but then continued to drift lower as reality set in and showed that the system was still broken. But I agree with you. As you said, it's unclear because we do know. I only know now what's different from '08, and the difference is that we have seen more action in a shorter period of time from policymakers. But at the same time, I also think that the implication for each and everyone's life is also much more pronounced than what we have ever experienced. I mean, if you think about it at the moment, I read today an article in the FT that there's estimated 3.5 billion people at the moment at home.
Oh.
So that's enormous amount of, or that are affected by the lockdown one way or the other. Yeah. So this is an enormous amount of impact that we have not been dealing before. So I agree with your point of view, and then what you said is we don't know yet. REITs as the underlying, with a real asset as an underlying, is something that can give investors also comfort in times of uncertainty. What we don't know with REITs is how are the yields and the dividends developing, because there will definitely be an impact the longer these restaurants and shopping malls stay closed, the harder it will be to renegotiate your rentals as they come up for renewal, and that might have an impact as well. So that's why I think, again, hard to get the right timing. We don't know when it's over until it's over, and therefore it makes sense to space this out over a period of time so that you are not too too much exposed to that particular timing issue.
Yeah. We have any other question, Barbara, that's there, or?
Actually, we have a couple of questions left. So let me just pick one. SAP in developed markets or emerging markets, or lump sum investment in developed?
If I take this as an either or question, if I had to choose one, I would probably prefer the one with a wider or higher volatility, which is by historic measures an emerging market. Yeah? But it's a very difficult question to answer. It depends on the personal circumstances as well, to some extent, and preferences and risk appetite, also, and the investment sum. So, yeah. Ideally, I would say both.
Okay, cool.
But this is an interesting one, Barbara. This is the buying small increments into an ETF on every red day, or or a type of SIP itself. So, is it just about time, or is it about move in the market? So, I don't know. I'll state this. So, I guess both are possible. What do you think, Thomas?
I think it's hard to say, and this goes to another question that we had, is like, doesn't it make sense to have to invest in one shot if you feel that you're on oversold levels? Now we have seen this. We've seen this on the 9th of March, yeah, when we had the first really outside down day in S&P, where market has dropped substantially, and everybody was like, "Oh yeah, we dropped 5% in a day, and now that's the time to get back in." If you invest on a down day like that, you're still down. You were still down another 15-20% because you didn't know what was the bottom at that point in time.
Yeah.
These are the things we only notice with hindsight. So I would say this is, yes, you can buy on down days, but you don't know when another down day is going to follow. Another 20 down days will follow. So I would go, I think the spirit of it is more on timing wise. Now you can do dollar cost averaging, is also more looking into levels. Yeah, that you have a targeted sum and then you're just putting in your levels. You say, this is kind of like what I want to invest, and at these levels I want to get triggered. That's also a form of SIP, but that's a different way of averaging into a trade as well.
Yeah. There's one question on multi-country REIT. Actually, honestly, I don't know the answer myself. Edward, would you buy into a REIT which is investing in US or China or any other markets?
For me, I guess the whole question is what is your familiarity, that kind of local sense, whether if you feel that, Singapore REITs are something that you're familiar with, I think go for it, because sometimes, you're not sure whether US REITs is good for you because you're unfamiliar. I think don't go for it. So I guess it's the kind of local sense whether you have for the REITs. So that will be my answer. For me, basically, I think I'm familiar with Singapore REITs, so I only choose to go for Singapore REITs. That's my personal experience, because if not, I will have to research on other country REITs and have to go and study for it. I guess that takes some time as well. I guess the familiarity is something that you'll be comfortable with.
Yeah, if I may add to that one as well, a lot of the REITs that are listed in Singapore, they also have by now also very diversified exposure. So especially the larger ones that are on the market. So you're not necessarily only buying a Singapore REIT, but it is a REIT behind it that has an exposure to UK, Asia, Australia properties, and this is a bit more diversified across the market. So I think REITs have more evolved into thematic REITs, whether it's a hospitality trust or industrial or data centers, which are the latest big fashion in the REIT space. These things, they tend to be a bit more geographically diversified as well.
Okay. We have one more. No, we have a few more. It's okay.
Yeah. Very lively, which is good. I like that, actually. I'm happy to see a lot of questions. That's better than the other way around. There's one question I want to take as well with the currency factor, because I think this is one thing we actually have not really talked about that much, but we do focus on US a lot as the reserve currency, and given that we have majority of the investable universe is in US dollar versus Singapore dollar. I think there should be some diversification, and one of the things that we find is it is often harder to get exposure in Singapore in the ETF space. There's a limited number of ETFs that are available that allow us not so much of a diversification across sectors, but it's one thing from an SIP perspective, the same way how you're averaging out your costs of buying an asset, you're also averaging out your exchange rate risk. So if I look at Singapore dollar, I remember the first time I set foot into Singapore, Sing dollar was at 165. So now you know how long I've been here approximately. And it has been over time consistently appreciating. Yes, of course, that would have been negative. But in times of crisis, actually, when dollar appreciates again versus the Singapore dollar, it also acts a little bit of a buffer for your holdings that you have, if you are thinking from a Singapore dollar mark-to-market perspective.
Yeah, I guess the only thing I would add is reference currency, which means if you have multiple locations as a default reference currency, it's easier to organize your assets in terms of what's your reference currency and then take a view. And if that reference currency goes down, then we live with that choice because that's a reference currency we have chosen. So it's easier if the assets are aligned with our choices in life. So kids going for school or living in a place, retirement, family, a place of ethnicity, domicile, taxation, all of these things come into play. If they're simpler, if the question is simpler, then it's easier to kind of solve it. If it's complex, then those factors can complicate any decision around cross-currency investment decisions. In certain cases, then taking a loan and borrowing and buying that asset becomes an easier choice. We have one question, which is recommended asset allocation. So Barbara, can I say that they can, you should watch the previous discussion around asset allocation?
Yes, absolutely. So I think this is a big question, and everyone who wants to know more about asset allocation, yeah, please watch our other webinars, which you can find on YouTube. And yeah, we also have more questions on REITs. So I think there are a lot of questions about that topic. So maybe we can also have a specific webinar on REITs in the future.
Yeah.
And I think apart from that, we've reached our time limit. So if any of the participants wants to voice their question in person, please raise your hand. I can give you the option to ask your question in person. But if not, I think we should wrap it up now. Oh, we have one question actually. Hi, can you please state your name and your question?
Yeah, hi. Hi, this is Nipun Madan from India. So my question is basically for country like India, where most of our investments is in India only. Now, what is happening that our currency, rupee, is getting depreciated year by year, day by day. So what percentage of my assets should be in US or developed economies, so that we can get benefit of our depreciating currency, because there's a huge home biasness in our portfolios. Thank you.
Hi, Nipun. This is Thomas. Thanks very much for the question. I think it's a great question. Maybe I'll share with you the way how I think about that currency risk, and hopefully that helps to some extent answering that question. So it's difficult to give you an exact number of saying you should invest X percentage in overseas assets, but I would more like to demonstrate how I make the comparison. So in India, when you look at currency depreciation, it's always on a relative basis to what the assets are. And I think the home buyers, we don't only have this on India, we have this in many other countries as well, by the way, is that the home bias is created by very high returns and rates levels that are existing domestically and that people have grown accustomed to. So in India, when I speak to my colleagues and our clients, anything below 9% or 8% return is not interesting, because that's what you're accustomed to. But then what I think important factor is to keep into consideration is the inflation. And that's basically what's causing that drift in currency and in depreciation. So what I do in my mental model is I'm discounting returns that I have in overseas assets versus the returns that I see in Indian assets. And there might be at times a bigger difference than another one. So at that point in time, then that gives you the answer. Is it better to be over allocated on US dollar or have more overseas, or is it better to have more domestically if your expected rate of return adjusted for inflation that you're achieving on the Indian assets is on par or below what you would be achieving in overseas? Does that get a little bit there?
Yeah, thank you.
Yes. We have one question on where do I go to view the past webinars. Barbara, you will be able to send a message on that as to how to watch the past webinars?
Yes, I'll follow up with everyone, sending you the recording of this webinar together with the link to access our other webinars, which you can find on our YouTube channel.
Yeah.
But I will send that as an email. Yeah.
I mean, one of the things which we are also trying to do is to keep the topics and the discussion content around the webinars more interesting, and any feedback on that in terms of topics that are relevant would be helpful. Today we picked up one of the points which Barbara mentioned on REITs, so we'll work on that as well. I think we have pretty much addressed. We have one or two questions which we can answer. We can answer one-on-one, right, Barbara? We can do that.
Yeah. Actually, one-on-one, I don't know, but we can collect those answers and answer them also after the webinar just by including them in the follow-up.
Okay.
All right, then let's wrap up. Thank you, everyone. And thank you to a very big thank you to our panelists. And yeah, let's see you at our next webinar. Thank you.
Thank you.
Thank you.
Thank you. Bye.